So good morning, everybody. This is, I think, the 10th webinar in the COVID-19 series that Retirement Newcastle and Lower Hunt has given. Today, Steve Baxter's put a lot of work into some fairly positive slides, and I've tossed a few things in at the end. So, Steve, the recording's on, and over to you.
Excellent. G'day, everybody. Hopefully my phone doesn't decide to cut out again and lose audio. But we'll kick this off, and welcome to the first Fortnightly update. We'll be back again in 2 weeks and do this all again. The agenda, I'm actually not going to give too much of a virus update. Going to give a market update, which will cover off on a couple of things to do with the virus. But the feedback we've got from people is that they can get an update on what's happening on the virus in the news. So we're not going to spend too much time on that part. Talk about the market, talk about where we go from here, what our predictions are, and
we can't hear him.
Where we think we're going to go from here.
Actually, Steve,
and then obviously we'll open up. Yep.
Steve, I'm just hearing some background noise. Peter McBean, can you actually hear Steve Baxter talking? Put your hand up if you can. Peter McBean, can you hear me talking?
We've just about got you.
Right. So who was that saying that you could hear me?
That was Marianne.
Oh, hello, Marianne. Sorry, I can only see Peter's head smiling there.
Oh, there we are.
Yeah.
We've got you now.
Okay, so Steve, do you want to speak? Steve, start talking.
Yep, you can hear me okay?
Thank you.
Yes, can now, thank you.
Okay, excellent. Right. Okay, so we'll give a bit of an update, look at where to from here, then we've got Gil's insights, and then open for any questions. As usual, session should go 30 to 45 minutes. I did look at how many slides Gil's got, so I've told him he's got to talk quick. So we'll see how that goes, but we'll hopefully wrap it up in about 45 minutes. If you've got any questions as we go, there's a chat icon down the bottom. Put in your questions and we'll get to it either as we go or at the end. We've muted everyone's microphones, have we, Gil?
I think so.
If you're having any problems with the sound, it may be an internet issue, so try turning your video off. And we're going to record the session, so if you want to listen to it later, we'll have it up on our website, on the YouTube site. And if you want us to send it to you, we can do that on request as well. Similar with the slides. If you want the slides, let us know and we can send those to you. As usual, we've got a disclaimer down the bottom. I haven't changed the names, unfortunately, but today's content is general. It's nothing to do with your personal circumstances or goals. If you've got any questions that are specific to you, please direct them to your advisor and we'll help you with those. Okay, a bit of an update on the market. Last week, we actually saw the Australian share market down about 2.5%. We were going really well Monday, Tuesday, Wednesday. Then there was a bit of a change in sentiment Thursday, Friday, and into Monday as well, with increased infections in the US, which started to scare people a little bit. Yesterday, though, we saw the share market up nearly 4%, which really showed that sentiment's back on the rise. We saw the US up overnight as well, so there's a lot of positives coming back into the market, and I think the little bit of a pullback that we had at the end of last week was probably just a fairly short-lived thing, and we're going to see this happening over the short term. There's going to be ups and downs as we go. There's been another round of stimulus. The US Federal Reserve decided they're going to go in and buy individual corporate bonds. So up until now, most of their liquidity measures have been around government bonds, but they're going in and buying individual corporate bonds. The Japanese central bank basically said, we've got a blank check and we're going to go out there and do whatever we can to stabilise markets. So those things helped change that sentiment yesterday and help boost our markets. Also, we saw an improvement in Australian payroll data. This one's a little bit hard to read at this stage. The ABS has gone to weekly payroll data for the first time. We've only got about 4 weeks of data. So there's not a huge amount there and huge history there for people to really read that data, but it definitely indicates that more and more people are in work. That's all still skewed by the JobKeeper payment, and there's a lot of speculation now coming in about what's going to happen when the JobKeeper payment runs out, which is due to happen in September at this stage, and whether all of those people that are on the JobKeeper go back into work, or whether their employers decide at that point that they need to make cuts and some of those people end up on JobSeeker or some other payment. So that's all yet to be seen. The market now, with the bounce we've had, we're up over 30% from the lows of a couple of months ago. So it really has been a very strong and quick recovery from the lows that we saw. We're obviously not back to where we were in the end of February when we were at record highs, but the recovery still has been very sharp, and it's been really good to see. Okay, where to from here? I thought again I'd present a positive case and a negative case. Because at the end of the day, and I think I said this last time I presented as well, to ignore the fact that there is potential for negatives going forward. We're still positive, and to me, most of the data supports the positive case, but there is still the potential that things don't go as well as we're hoping. But the positive case basically centres around the COVID-19 disaster being similar to some sort of natural disaster, earthquake, hurricane, something like that, where the effects very sharp. We see an almost immediate fall in market, but then the recovery tends to be quite sharp as well. And with economies reopening a bit quicker than what we initially expected, tend to be seeing that sharp recovery. Things that may help to drive that recovery: spare economic capacity. It's a bit of a euphemism in economic circles for high unemployment. Means there's plenty of people out there that we can get into work to drive growth, and potentially means that employers don't have to pay as much for them. When there's unemployment out there, you can get cheaper skilled labour. So that could help drive growth, and also the idea of a vaccine sometime in 2021 could definitely spur increased growth. And there's a lot of positives in terms of the vaccine talk. Very low interest rates is a huge thing, and I think Gil's going to talk about that a bit more later too. But we're really in a situation where, with interest rates as low as they are, you've almost got no choice other than to put money into the share market. There's nowhere else to get returns. A lot of clients are coming to us and saying, we can get maybe 1.5% in a term deposit or a high interest online account. And that's not enough for a lot of people now. So a lot of them are looking for investments like the share market that can produce higher returns. On the negative case, we've still got a situation where there's a lot of debt in companies out there. And if this shutdown from COVID causes long-term structural damage, which it is going to in some sectors. I mean, if you look at the travel industry, airlines, things like that, they're looking at long periods without going back to normal. We may not see international travel anything like normal for another 12 months. It could be until we get a vaccine that really the world opens up for international travel again. So those sectors could be in a bit of trouble, which could lead to bankruptcies, etc. Leads to increased unemployment because those companies aren't obviously employing people. Financial stress for individuals, which can then put pressure back on banks, etc., as there's defaults on loans and things like that. At the moment, though, all the data definitely seems more supportive of the positive case. Unemployment rates are coming down. People are getting out and spending money. And just anecdotally, I mean, you look around here over the long weekend, I was out and about a bit over the long weekend, and everywhere I went, there was just people everywhere. And it was, I think, a lot of that, people have been cooped up for so long, and now they're allowed a bit more freedom, and people want to get out and do things and spend money. So it's quite positive at this stage. And we're not going to know definitively for another 3, 6, even 12 months. But yeah, the initial data is all looking very good, and it looks like things have bottomed out and we're definitely on the way back up. Looking at predictions going forward, these are, I guess, the official predictions. The OECD came out with a range of predictions here in a couple of scenarios. So the blue line there, blue bar, is what happens if essentially there's one wave of COVID. And you can see they're predicting negative growth across the world. Australia predicting about -5% for 2020. Where are we? US is about -7 or 8. Some countries in Europe, you're looking at -11. And you've got to expect that there's going to be a downturn. Effectively, we've had 3 months or so where the big parts of the economy have been shut down. There's no way that we're not going to have a negative year. The interesting part is that in most countries, even if there is a second wave, that second wave is predicted to have a lot smaller impact than the first wave. And I think part of that is the expectation that if we do have a second wave, countries know that they need to jump on it quite quickly. And they've already sort of got things in place, and people are prepared for the kind of measures that might need to be put in place if there is a second wave. So most countries, I think, will be able to jump on that fairly quickly, which means the length of time of any sort of increased shutdown is likely to be lower. So, as I said, in most countries, that second wave is a lot smaller contributor to any decrease in growth. Interestingly, in some of the more developing countries, so India, Turkey, that second wave is predicted to have a bit more of an effect. And I guess that's because they don't quite have the same infrastructure in place to shut things down quite as quickly. And I guess a country like India, with a large population, fairly densely populated, there's potential for some serious issues there. Okay, key factors going forward that we need to sort of keep an eye on. There's, which we just touched on there, risk of a second wave, but particularly in the US, and this is part of what drove some of that negative sentiment last week and into early this week. While overall in the US, their growth rate in cases is pretty flat, there's some areas that are still going up, and there is concern about hospital capacity. There's places like Houston that they're talking about going back into some sort of lockdown again. And with what we've seen in China over the last little while, it does show that the virus can lay dormant for a while and then come back. So, governments still need to be very vigilant. And I think they are so far. And we're seeing a lot more testing, which is part of why we're seeing, I think, so many more cases coming up, because we're actually testing for it now. Whereas before, if you look at Australia, it was almost impossible to get a test. Whereas now they're encouraging everyone to go out and get one. And so we've got a lot better idea of the actual numbers out there. Other factors, medical developments, there's a lot of positive news there still on therapeutics. So that's either treatments for people's symptoms once they've got it, or for a vaccine. So at this stage, there's quite a positive trial about to start on a mix of antibodies that can treat symptoms. There's also a number of vaccine trials that we'll see results on in the coming weeks. There's a lot of positivity around potential that one of those or multiple of those could lead to a vaccine that we could see start to be rolled out. Other factor is the economic impact of things reopening, which continues to look really positive, particularly here in Australia. We saw last month restaurant bookings were down over 80%. which you would expect because basically you couldn't get into a restaurant. They had this person limit, I think, towards the end of the month. Now they're only down about 17% on this month last year. So we're almost back to where we were. Still down a bit, and I think that's still due to the restrictions, and it's just a little bit hard for some people, where you've got to book ahead and think a bit more. You can't go out in big groups, things like that. So I think it's going to be a little while before we get right back to where we were. But again, the initial signs all very positive. We've got concerns around policy across the world. Central banks are all continuing with their stimulus. There's a little bit of concern about what happens with the US government stimulus. They have a package that's in place till the end of July. There's a lot of talk that they need another $1 trillion or $1.5 trillion of stimulus to kick in after that. And we've seen in the past, if you think back to, say, the debt ceiling issues that they've had in the past, where you get this political wrangling and the opposition steps in and says, okay, we might let you do this, but you've got to do that for us and that sort of thing. And that's more likely to happen as we see cases decrease, death rates go down, political parties start to think that they can get a bit of traction, I suppose, out of some sort of opposition on this economic stuff. Early on, no political party is going to step in and argue about anything. They're going to agree and say, yep, this is great, we're fully supportive, try and get some traction out of that. But the longer this goes, the more you can see opposition parties start to step in. We've also got a US election at the end of the year. There's a lot of talk that from about August we might see some sort of instability around that, and we'll see how that goes. There's still the technical trading. So we've talked about before, so much of the trading on share markets is done via computers and algorithms that they've got. And a lot of the algorithms are built on what they call technical factors. So when the market gets to certain points, or there's certain indicators that get to certain points, then they'll either buy or sell based on that. A lot of the short-term indicators suggest that the market's a little bit too high. However, the medium and longer-term signals are still pretty supportive. So we're not expecting, big long-term falls on those, but we may still see that short-term volatility that we've seen over the last little while. Oops, that should have been gone, and that should have been gone. Done a good job of editing that. Okay, Gil, over to you.
Okay, good morning, everybody. You can hear me all right, Steve?
Yep. Do you want me to stop the sharing and you grab it?
I think so, yep. Let me just grab the right slide. Just come in there. Yep. And so hang on, where are we here? So I'll share my screen, which should be that one. So you can see it, Steve?
Yep, that's all good to go.
Okay, so presumably you can hear me as well. So good morning, everyone, again. Yep. Thanks for tuning in. I've decided today to spend a little bit of time on basically the money market, the investment markets. We talk a lot of the time about liquidity and government printing money, and we don't really get too much into the effect of all this extra cash in the system. So I'm going to give you a little bit of background about how investment markets work. Excuse me, from my new office somewhere in the Seychelles. Okay, so we're just sort of looking at this question of what drives investments. So is it growth in turnover? Basically, the business is growing value and that what makes things go up? Or is it potential exposure to new markets? The answer is actually no. The answer for what drives stock markets and investment markets is literally profits. So if any of you have read that great book, Rich Dad Poor Dad by Robert Kiyosaki, he talks about how experienced investors know they've made money. And the answer is they tend to focus heavily on the income that portfolios generate. So in terms of the shares, you want to know that the Commonwealth Bank or the BHP or the Rio Tintos or the Telstras are going to make profits this year, next year, and the year after. And what you're doing when you're buying a share is buying a share in those future profits. So this is very much a sort of show me the money kind of vibe for those of you that remember Jerry Maguire. So look at things in that context, and this will all start to make a bit of sense. Let me just clear a bit of space away here. Okay, so I'm going to start with an opening question of how much money is there in the world. So the answer is there's roughly $6.7 trillion in the world of printed money. So this is money that is actually been printed by way of notes or coins or what have you. Now, there is a heck of a lot more money in the world than that. If you include all the electronic money, which is stored in bank accounts, there's roughly $95.7 trillion US dollars of money issued in the world. So what this is telling us is that 93% of all the money that we have out there hasn't been printed, never has been printed, which is a really interesting notion when you start to think about how money and the world economy works. So when we look at debt, there's another interesting question. There's in fact $253 trillion worth of debt, which again is roughly 2.5 times the amount of money that exists in the world. So this is a slight sort of inconsistency here. How can you owe money when the money doesn't exist? And the answer is it's predominantly electronic. Now, the interesting thing is that the global gross domestic product, the total turnover of every dollar of trade that exists in the world is only roughly $84 trillion. So some interesting things here that maybe are not immediately obvious when you think about going down to the shop and buying a bag of lollies. So 27% of that debt, roughly $70 trillion is government debt all around the world. $47.6 trillion of it belongs purely to the investment sector. Now, these are the people that borrow money and buy and sell shares for you. And when you invest $1 and someone else borrows $1 and invests it, you've got $2 working for you. But at these interest rates, it costs you virtually nothing to borrow $1. So we're seeing a lot of debt all around the world in the financial sector. Now, in the household debt, which is mum and dad and mortgages and cars and things like that, it's only $60 trillion. And the rest of the world debt is made up in basically the debt that is owned by businesses. So this is company debt, essentially. And there's 2 or 3 different types of company debt, but that's roughly where it lands. Now, there are 3 or 4 major types of asset classes. Property is one of them, but we're not really going there today because we all understand that reasonably well. I'm just going to talk about cash versus bonds versus shares. So cash has the least amount of risk or capital volatility. It's physical money and it's the electronic money we talked about. But essentially, it's money in the bank, whether it's on a computer or whether it's physically stored in the bank. It really offers the lowest return, somewhere between nothing and about 1%. In some parts of the world, the cash rate's actually negative, which means when the bank holds your money, they charge you for the privilege. Now, the thing about cash accounts is you can't sell your cash or your term deposit to anyone else. You have to shut down a term deposit and move your cash to somebody else. When you look at government bonds, these are essentially money that has been borrowed from you and I in one form or another, and it is guaranteed to be repaid. Now, generally, it's guaranteed by governments, so state governments and federal governments. In some parts of the world, the governments are local, which are your local councils and things like that. It can also be money that companies have borrowed from the market. Typically, it has what's called a coupon, which is a debt payment or an interest payment every 6 months. But the debt will last for 3 years or 5 years or 10 years. And at the end of that time, the money will be given back to the investor. It's a guaranteed trade or refund. Now, the majority of the return that comes from these investments comes as income or a coupon. But the thing that's different about a government bond is that it can be traded. That is, I can sell Steve my government bond. We don't need to give the money back to the government or the government doesn't need to repay my bond out and then get more money from Steve. I can literally just trade the contract to Steve. Now, when we look at the share market and property, it is much higher risk. I don't think anybody now is looking at investment property and saying it's guaranteed to never fall in value. It clearly does in times like this. And likewise, industrial properties and commercial properties have fallen quite strongly, mainly because of the lack of turnover in the companies and the risk like that. So the money with these investments is permanently invested, right? Effectively, your money's in there. You cannot really force the property or the share to give your money back. They can actually elect to do it. But generally speaking, you have to sell your interest in that company or that property to get your money back to someone else. So it can only be traded on stock exchanges if we're talking about shares. Now, the reality is by the time you get to shares and property, you're generally looking at roughly 50-50 returns. So your returns come as income and growth in the value of the shares. Now, Australia is a particularly unique market where 2/3 of the returns that you get from the share market come by way of income. And that's what's made us hands down the most successful stock market in the last 120 years. And it's because of Australia's pragmatism. But again, and you've heard me say it many times, why would you live anywhere else in this country? This is hands down the best, most politically stable, least racist, least difficult place to live in the world. So how do bonds actually work? We've got an interest rate. So if we invest 4%, if we invest, say, $100,000 at 4%, we're going to generate $4,000. That's essentially a term deposit. It might be for 3 years or 5 years or 10 years, but it is going to generate the $4,000 income. Now, if interest rates fall to 3%, you actually have to invest more to get that $4,000 income. So you would have had to invest at $133,333, to be honest, there's a typo there, to create the $4,000 income. So if Steve now says, hey, Gil, I've got this government bond at 4% and interest rates around the rest of the world are at 3%, Steve can sell that bond to me for more than his original purchase price. So when interest rates fall, the value of the original bond goes up in terms of its capacity to be sold. But conversely, if interest rates went up to 5%, I only need to invest $80,000 to generate that same $4,000 income. So this has the effect of decreasing the value of the original $100,000 investment. So this is an interesting thing to understand because it goes ultimately straight to economic recovery and so forth. But interest rates falling means that bonds will increase in value. Interest rates rising means that bonds will decrease in value. Now, if we take a bit of a look, and many of you have listened to a few of these, this is my favourite LIBOR rate, my London Interbank over-the-counter rate or offer rate. So over the last 20 or 30 years, we've seen the prevailing interest rates that banks lend money to each other at drop to basically nothing. You know, in historical terms, you know, the 2%, 4%, 6% was where it was at. We saw in the GFC this little spike here where everyone got nervous, but then interest rates fell and stayed down. Now they're all down again, okay? Now the interesting chart, if you can see the detail here, is this yellow line here. That's the 12-month rate, which basically means banks at the moment are lending money to each other in London at around 0.75% per annum. So as far as they're concerned, they're willing to accept less than 1% if they lend money to one of their colleagues. So that's a very strong signal that interest rates are extremely low, and to be honest, they are as low as they have ever been. Now, I was digging around on the internet and I couldn't help but show you this chart. This is interest rates from the 1300s to now. So this is basically government bonds or when governments were borrowing money. Now, if you want a history lesson, then maybe send some feedback in here. This was fascinating the way that the Dutch actually invented the notion of government bonds and lending money to merchants and governments to fund wars and things like that. So the actual bond market started in Europe, and it was one of the reasons that Europe actually ended up taking over the world, because prior to that, all the government could do to raise money was to tax the life out of their constituents. When they realized that if they borrowed money from the investors and from the market and then treated that as a genuine debt instead of some sort of capricious loan to the monarchy, then all of a sudden the economy of Holland exploded and they became a world force. So that was quickly learned by Spain and Portugal and a variety of others. but the history of government debt around the world is actually the history of the triumph of Christianity in terms of the economic and the Western world model. It's a history of why the Arab world did not win in the great economic expansion and the Industrial Revolution. So some very subtle things that give rise to the reasons why one culture or one country triumphed over another. But to my point, if we look back at the history of government debt since the 1300s, it is as low as it has ever been. Now, what that tells me is that the chance of it going much lower is really, really modest, right? It was down about where it is now in World War II, and from there, all it did was go up, right? There was massive expansion in the economy after World War II. Now, we're going to see a similar expansion associated with the amount of money being printed all around the world. But the point here is that the probability that interest rates are going to fall from here, and therefore people that own bonds are going to do brilliantly well out of it, is actually fairly small. So we're in a scenario where the most likely trajectory for interest rates is upwards, which is actually not great for government bonds. So let's have a bit of a look at some of the bigger factors, because when you can't put money into cash because you get no return, when you can't put money into bonds because you're going to get no return or run a risk of negative return, you're kind of stuck with two alternatives. One's property, which we're not going to deal with today, and the other one's the stock market. And we're dealing with that because that's what your portfolios are invested with. So if you look at how much money's in the stock market, and these are 2016 figures, there's roughly $70 trillion in all the stock markets around the world. Asia had 33% of the stock value in the world. Australia, only 1.75%. Europe, about 20% of the world's stock market value. North America, 40% of the world stock market value, which is really interesting when we overlay this later with population, but I'll get to that in due course. Africa, essentially not very much at all, given the size of the country. South America, even less. So when we look all around the world at the size of the stock markets and the value of these stock markets relative to their population, we see some really interesting figures. So here in the green, that's the 40% of the US. Europe is around 20%, and Asia, which goes all the way across to India, represents about 33%. Now, Australia, it's actually, we punch way above our weight given our population, but the reason we do that is because we are a resources and an energy country, now a food country, and that has immense value because of our proximity to the rapidly expanding Asian region. So one of the reasons, and I'll come back to Australia, I tend to finish these things on a positive note, but there's some really good demographics here. And as I say, demographics are destiny. If we look here at where are the people in the world, and we overlay that against where the stock market is, we get some fascinating stuff. 60% of all the people in the world live in our part of the world. Another 17% of it live in Africa. Now, I want you to notice the geographical proximity of Australia to 87% of the world's population. And this is a really big thing to think about. These two countries, 87% of the world population, are where all the action is going to happen over the next 50 years in terms of economic growth. It's not to say that Europe and North America are important. They are, right? Europe's 10%, South America's 8%, and North America's 5%. But substantially, the opportunity to sell food, sell energy, sell raw materials into these countries is fully maximized by the countries themselves or the regions themselves, and the fact that those markets have existed and been so very healthy for so very long. Now, what's going to happen here with Australia over the next 20, 30, 40 years is we're going to see growth in Asia, we're going to see growth in Africa, and some extent growth in South America, although they have a lot of similar resources to us. Not all. They've got a lot of food and they've got a lot of fine rare earths and things like that. And in Brazil, obviously, iron ore. So they are a little bit less in need of our support. But Africa and Asia, where 87% of all the action is going to be happening over the next 50 years, has no natural gift of our resources. Now, Africa actually does have those resources. They have a lot of mineral resources and a lot of energy there, but they are woefully underdeveloped as an economy. They don't have the infrastructure to deliver consistently on those promises to either their own nation or to Asia. So we're just in this funny spot right now where if you look at South America, whilst they are somewhat of a competitor to us, they have a real problem with COVID-19 and their infrastructure is underdeveloped. North America, not so much problem with infrastructure, but they're consuming their own resources. Australia is in this absolute cherry position to provide what's going to happen around the rest of the world over the next 50 years. Now, there's some interesting things happening, what to do with all the money. Do we stick it in cash? The answer is no, generally speaking. They don't want, you're not going to earn anything and you're going to lose money against inflation. Do we stick it in bonds? Well, traditionally, yes, but the growth potential in bonds is very, very modest. So I see a couple of questions. I've got a question there from David and Steve's answered that, that's fine. So back to the slides. Do we look into the share market? And the answer is, to be completely truthful, yes, it's going to happen. Companies and financial traders, these are the people that borrow money and buy and sell things, have access to very, very cheap money. Why would the governments around the world, why would the stock markets throttle themselves because they can't get access to money when interest rates are at 1 or 2 or 3% for them, and they can generally make 10, 15, 20% when they invest that money. Growth prospects around the world are moderate to strong. For Australia, what we sell is what our nearest neighbours need. Wage pressures, which are the largest cost in the Western economy, is now going to be low. The unemployment factor will drive wages pressure down, which means that there's actually what they would call productivity available in there, where they can get change the way people are employed. And an international trade war, I think everyone knows this, is starting between the Western world and China. It's interesting, I don't know if I mentioned this last week, but China's obviously making noise about how unsafe it is for Chinese students to come to Australia because of racism. But Chinese students tend to go to one of 4 countries around the world: the UK, the US, Canada, and Australia. Right? Now, if I was a Chinese parent, I wouldn't be sending anyone to the UK because their COVID-19 risks are much higher. The same in the US and Canada, although Canada's better than the US. The safest place to send your children right now is the country with the lowest COVID rating in the world and the best education system, which is Australia. So what happened when China started to squawk about iron ore and squawk about education? The irony is that the number of inquiries to come to university in Australia has gone up, and the iron ore price is in excess of $100 a tonne. So the reality is that we're not, there's a lot of reason to think that this noise from China is going to slow down. I didn't put animation on this, forgive me, but I will finish up on these things. That China and the Western world is going to affect geopolitics for the next decade. There is a fight going on, and I would encourage anybody who's interested in this to have a look at this document. Write this down if you can. United States Strategic Approach to the PRC. Now, this document is not lightweight and fluffy. It is a declaration of economic war against China. It's come from the White House, but it has bipartisan support in America. And we're seeing right now in Australia, and the same in the UK, Europe and Canada, some fairly strong words about Chinese bullying. You've seen me building up to this sort of stuff over the last few weeks, but it's going to be the game over the next 10 years. The irony, of course, is that China needs us, I think, more than we need them. So the reality is Australia does have to broaden its exports. It does. But Australia is probably the most reliable provider of energy, food and minerals in the world at the moment. We have easy access to the dominant growth markets of Asia and Africa, and we can prosper with good management. So we're in this scenario where I actually think most of us would admit the government's responded appropriately, but Labor or Liberal doesn't matter. When stuff goes really dumb and ugly, we tend to find good decisions being made by Australians, which is why I say over and over again, why would you live anywhere else? The truth is it's going to be an interesting 12 months, but the cheap money is going to drive stock market returns quite healthily. The posturing of China versus the Western world is going to be a factor as well. So again, we see volatility. but the inevitable consequence of the government printing, 5%. I mean, I didn't mention it earlier, but if there's $97 trillion of US dollars in the world of money, the Federal Reserve, or the Reserve banks of the world are basically saying we will print as much as we need to bring this world and this economy back under control. So if you take an extra 5 or 10% of the cash in the world and you go looking for a home, there's only two places for it. One is property and the other one is the stock market. So as I've said before, this is going to be a big and interesting 2 years. I suspect within 5 years, we're going to see immigration back to record levels, because that is how Australia, in combination with selling food, energy and minerals to the world, the other way we've kept ourselves economically vibrant is immigration, because it keeps the population and demand in the country growing. If you can't make them naturally, then bring them in. So broadly speaking, I stay, as Steve did, fairly positive. Of course, there are storm clouds on the horizon. We're not naive about that. However, there are so many, there are tsunamis of things going on around the world that are inherently lead in one direction. So again, thank you for your time today, folks. I hope you've enjoyed this session. Please provide us with some feedback. For those of you that want to go deep and try to figure out where the big elephant movements are going on, read that document on the screen in front of you. It's a fascinating read, and it is a declaration of war, economic war, but not trade sanctions. It's just all out willingness to say you either play fair or we're going to come against you. And that's what's going to be happening over the next few years, which I suspect is going to lead China within 6, probably 12 months to take a more conciliatory attitude to the rest of the world. They won't say that, of course, but the inevitability is that they need to trade, and it's in everyone's interest if they do. Okay, so thank you very much. Provide feedback. We love getting your feedback. It's generally pretty good. We'll be doing this again in a fortnight. I trust that you're all well and your families are safe. And if there's any questions you have or anything you'd like to know while we're doing these sessions or afterwards, of course, give us a ring. We're sitting here waiting. Some of us, or many of us, are back at work, obviously, because I'm wearing the dreaded suit. And so is Steve. He's wearing a collar, which we see as an improvement on T-shirt. But the world is reopening. The offices are reopening. We look forward to speaking with you. Take care. Stay safe. God bless.